Hello, everyone. Welcome to the market opening bell for Wednesday, August 13, your 10-minute guide to the stock market. A joint US-China statement announced a 90-day suspension of the 24% reciprocal tariffs, while markets are closely watching upcoming US inflation data, leading to an uneven rise in Hong Kong stocks. The Hang Seng Index opened 82 points lower, dipped 105 points to 24,801 in the morning, but later climbed 109 points to 25,016, ultimately closing up 62 points or 0.25% at 24,969. The A-share index gained 28 points or 0.3% to close at 8,916, while the Hang Seng Tech Index fell 20 points or 0.4%, ending at 5,439. Total market turnover reached 215.4 billion Hong Kong dollars, up from 209 billion dollars the previous day. Southbound funds saw a net inflow of 9.45 billion dollars into Hong Kong stocks, with significant net purchases in tracker fund at 4.161 billion dollars. Hang Seng China Enterprises ETF at 1.873 billion dollars, Tencent at 898 million. Alibaba at 648 million, Xiaomi at 384 million, SMIC at 305 million, and XTPI at 101 million. On the other hand, net sales included Kuaishou at 2.375 billion, Hua Semiconductor at 241 million, and Meizu at 199 million. Notably, southbound funds have been net buying Xiaomi for 4 consecutive days, totaling 3.141 billion Hong Kong dollars. From a technical perspective, the Hang Seng Index continues to face resistance at the 25,000 level and the 20-day moving average, awaiting a potential breakout. On the mainland, all three major A-share indexes closed higher, with the Chinex index rising over 1%. The Shanghai Composite gained 18 points or 0.5% to close at 3,665, while the Shenzhen Component rose 60 points or 0.5% to 11,351. Combined turnover for the Shanghai and Shenzhen markets hit 1.8814 trillion yuan, an increase of 54.5 billion yuan from the prior day. The renminbi central parity rate was set at 7.1418 per US dollar, down 13 pips from the previous day, marking 3 consecutive days of decline. On the policy front, recent State Council meetings outlined interest subsidy policies for personal consumption loans and service industry loans. Banks are swiftly implementing these measures, streamlining procedures to ensure rapid and precise execution. For personal consumption, the focus is on loans for car purchases, home renovations, tourism, and household appliances or furniture. For the service industry, tailored credit products are being offered for sectors like catering, tourism, elderly care, and housekeeping, with plans for further optimization based on policy guidance. In Hong Kong stock news, Kuaishou saw its share price plummet over 9% to 71.6 Hong Kong dollars after reports surfaced that it is venturing into self-operated e-commerce with the launch of the Kuaishou official self-operated flagship store on its app. This store collaborates with source factories for direct shipping, cutting out intermediaries. However, compared to JD.com's mature warehousing and supply chain, Kuaishou's system is still in its infancy, lacking nationwide warehousing support, which could result in delivery delays. Additionally, Kuaishou's local life division recently introduced a standalone takeaway entry on its group purchase page, covering categories like burgers, pizzas, coffee, milk tea, and fast food from brands such as KFC, McDonald's, Luckin Coffee, and Starbucks. Products are split into takeaway or dine-in and takeaway only, with most of the latter sourced from Meituan. Kuaishou's takeaway model primarily relies on third-party collaborations, focusing on promoting high-quality dining options, with plans to expand merchant and category coverage. This approach resembles an aggregation model, partnering with local dining businesses, leveraging platform traffic to drive orders, and integrating third-party delivery networks like Meituan and Ele.me. With over 600 million monthly active users as of 2025, particularly strong in lower-tier cities and rural areas, Kuaishou's short video and live streaming formats provide high interactivity and conversion rates for e-commerce. Its e-commerce GMV exceeded 1 trillion yuan in 2024, showcasing its potential. However, it faces stiff competition from giants like Taobao, JD.com, and Pinduoduo, especially the latter in lower-tier markets. In the takeaway sector, dominated by Meituan and Ele.me, with over 90% market share, Kuaishou, as a latecomer, may need to invest heavily in user subsidies, merchant partnerships, and delivery efficiency. Relying on third-party logistics could lead to high costs or inconsistent service quality, while building its own logistic network will require significant upfront investment. Additionally, users accustomed to ordering on established platforms like Meituan and Ele.me may need incentives such as live streaming discounts or exclusive dining brands to shift their habits. On the corporate earnings front, Hong Kong Electric reported a 0.1% year-on-year revenue decline to 5.567 billion Hong Kong dollars for the first half of 2025, driven by a 3.2% drop in electricity sales due to milder weather, effective energy-saving initiatives, a sluggish catering and retail sector, and one fewer day compared to the leap year in 2024. Net profit rose 5.7% to 1.001 billion Hong Kong dollars, with earnings per share at 11.33 Hong Kong cents and an interim dividend of 15.94 Hong Kong cents per unit, unchanged from last year. Wharf Holdings saw a 19.4% drop in revenue to 5.669 billion Hong Kong dollars, but swung to a profit of 535 million dollars from a 2.637 billion dollars loss the prior year, with earnings per share at 18 Hong Kong cents and an interim dividend of 20 Hong Kong cents, also unchanged. Excluding investment property revaluation losses, underlying net profit grew 3% to 2.035 billion Hong Kong dollars, supported by lower interest expenses and taxes, though revenue was dragged down by a 64% plunge in development property income due to weak demand in Hong Kong and mainland property markets. Investment property income fell 4%, reflecting pressure in commercial real estate, but a 7% rise in hotel revenue signaled a tourism recovery, with logistics providing some stability. China Unicom reported a 1.5% increase in first half revenue to 200 billion yuan, with pre-tax profit up 5.1% to 17.8 billion yuan. Networking communication revenue reached 131.9 billion yuan. Computing network intelligence revenue hit 45.4 billion yuan, 26% of total revenue, and international business revenue grew 11% to 6.8 billion yuan. Strategic emerging industries accounted for 86% of revenue, driving high quality growth. The board declared an interim dividend of 0.2841 yuan per share, up 14.5%. Galaxy Entertainment posted strong results with first half net revenue up 8% to 23.2 billion Hong Kong dollars and adjusted EBITDA up 14% to 6.9 billion dollars, reflecting Macau's gaming and tourism recovery. In Q2 net revenue rose 10% year-on-year and 8% quarter-on-quarter to 12 billion Hong Kong dollars, with adjusted EBITDA up 12% year-on-year and 8% quarter-on-quarter to 3.6 billion Hong Kong dollars. The launch of the ultra-luxury Galaxy Macau Capella and events featuring G-Dragon and Jackie Chan drove record single-day footfall of over 123,000. Looking ahead, Galaxy's premium positioning and diversified offerings should benefit from market recovery, though mainland policies in competition pose risks. 361 Degrees reported steady growth with first half revenue up 11% to 5.7048 billion yuan and e-commerce revenue soaring 45% to 1.82 billion yuan. Net profit attributable to shareholders rose 8.6% to 857.7 million yuan, though margin pressures from costs slightly tempered profit growth. The board proposed an interim dividend of 20.4 Hong Kong cents per share with a 45% payout ratio. Tencent Music's Q2 revenue grew 17.9% to 8.44 billion yuan, with adjusted net profit up 33% to 2.64 billion yuan. Online music service revenue rose 26.4% to 6.85 billion yuan, with paid users up 6.3% to 124.4 million and monthly revenue per paid user increasing from 10.7 yuan to 11.7 yuan. Companies announcing results today include Tencent, Chongqing Infrastructure, Lenovo Group Power Assets, Nexteer, Samsonite, and Value Partners. Tencent is expected to report Q2 revenue of 179 billion yuan, up 12.2%, and adjusted net profit of 62 billion yuan, up 23.5%, driven by steady gaming growth, slightly slower advertising growth, AI-enhanced ad efficiency, and continued momentum from its WeChat channels. The U.S. inflation rate in July remained stable and below expectations, boosting market hopes for a September rate cut. U.S. stocks surged significantly, with the Dow Jones Industrial Average climbing as much as 522 points, ultimately closing up 483 points or 1.1% at 44,458. The S&P 500 rose 72 points or 1.1% to 6,445, while the Nasdaq gained 296 points or 1.4% to 21,681, with both the S&P 500 and Nasdaq hitting record closing highs. Major tech stocks performed strongly, with Meta rising 3.2% and Apple up 1.1%. Tesla and Nvidia each gained 0.5%, following a meeting between Donald Trump and Intel's CEO, which Trump described as very interesting. Intel's stock surged 5.5%. Stablecoin issuer Circle reported a 53% year-on-year revenue increase to $658 million in the second quarter, though its net loss widened to $482 million, primarily due to expenses related to its June listing. The company projects other income for the second half of the year to range between $75 million and $85 million, with adjusted operating expenses expected to be between $475 million and $490 million. Circle also anticipates its stablecoin USDC's circulation to grow at a 40% compound annual growth rate. The U.S. Consumer Price Index CPI annual rate for July held steady at 2.7%, matching June's figure and falling below the expected 2.8%. Core inflation, excluding food and energy, accelerated to a 5-month high of 3.1%, up from 2.9% in June and above the 3% forecasts. On a monthly basis, CPI rose 0.2%, slightly below June's 0.3% increase, but in line with expectations. Core CPI, as expected, increased by 0.3%, marking the largest rise in 6 months compared to a 0.2% previously. Our stock pick today is Eternal Beauty, stock code 6883. Eternal Beauty primarily engages in the retail, wholesale, and distribution of perfumes, cosmetics, skincare products, personal care products, eyewear, and home fragrances in China. Unlike brand-owning perfume groups, Eternal Beauty focuses on selling and distributing products sourced from third-party brand licensors, generating revenue from these activities and providing market deployment services such as brand management and designing and implementing customized market entry and expansion plans for these licensors. Based on 2023 retail sales, the group is the largest perfume group in China, including Hong Kong and Macau, excluding brand-owning perfume groups. As of March 31st, 2025, the group's products are sold in over 400 cities across China, including Hong Kong and Macau, through more than 100 offline point of sales (POS) directly operated by the group and over 8,000 POS operated by retail customers. Additionally, the group sells products to offline distributors who may further resell them to other offline retailers. Beyond offline channels, the group also sells products online through well-known e-commerce platforms and social media platforms in China. Currently, the group distributes products and provides market deployment for a total of 72 external brands, including Hermès, Van Cleef & Arpels, Chopard, Albion, and Laura Mercier, covering a diverse range of price points and functions to meet the varied demands of consumers in mainland China, Hong Kong, and Macau. In addition to external brands, the group owns a proprietary brand, Santa Monica, under which it offers perfumes and eyewear. The group's business and financial performance have maintained growth. Revenue increased from 1.699 billion yuan for the year ended March 31st, 2023 to 1.863 billion yuan for the year ended March 31st, 2024, and further to 2.083 billion yuan for the year ended March 31st, 2025. Similarly, net profit grew from 173 million yuan for the year ended March 31st, 2023 to 206 million yuan for the year ended March 31st, 2024, and further to 227 million yuan for the year ended March 31st, 2025. The total perfume market size in China, including Hong Kong and Macau, measured by retail sales, grew from 14.6 billion yuan in 2018 to 26.1 billion yuan in 2023, with a compound annual growth rate (CAGR) of approximately 12.3%. It's projected to reach 47.7 billion yuan by 2028, with a CAGR of about 12.8% from 2023 to 2028. The mainland China perfume market grew from 11.4 billion yuan in 2008 to 22.9 billion yuan in 2023, with a CAGR of approximately 15% and is expected to reach 44 billion yuan by 2028, with a CAGR of about 14%. Recommendation: buy at 2.18 Hong Kong dollars. Target price $2.4. Stop loss at $2.08. I do not hold the above stock.